Hello traders, you're welcome back to the Forex Geek channel. In this video, we're diving into one of the most effective trading strategies, which is combining moving averages with candlestick patterns for smarter trade decisions. All right. Now, moving averages help us identify trends, but candlestick patterns give us real-time signals of market sentiment. All right. When you put them together, you can filter out noise and make better trade entries. So stick around because I'll show you exactly how to use this combination to increase trade accuracy and avoid false signals. All right, before we get started, hit that like button and subscribe if you're serious about improving your trading skills. Okay, now let's just get into it. First of all, let's quickly cover what moving averages are and why they matter in trading. Okay, now a moving average is a technical indicator that smooths out price fluctuations. I'm going to add the moving average to the chart right away as I explain further. Okay, so the moving averages help to smooth out price fluctuations over a specific period. This helps traders to identify the overall market trend and key areas of support and resistance. Now we have two main types of moving averages, which are the SMA. The SMA, simple moving average, is a basic average of price over a set period. And we have the exponential moving average, the EMA, which reacts faster to price changes by giving more weight to recent data. Now this is how the EMA looks like, and this is how the SMA looks like. Okay, so you will notice that the EMA actually responds faster to price changes. Can you see? It gives more weight to recent prices. All right. Now, the most commonly used moving averages are the 50 EMA and the 200 EMA. Now, this is the 200 EMA. Then let me just add the 50 EMA to the chart. Okay. So this is the 50 EMA. These are the two most commonly used moving averages for trend direction. And then another commonly used EMA is the 21 period, the 21 period EMA. Okay, and then the 9 period EMA is also popular. Is a popular period EMA that is used, right? The 9 EMA and the 21 EMA are usually used for short-term price action signals. Okay, now let's talk about candlestick patterns and why they are essential. Candlestick patterns tells us how buyers and sellers are reacting in the market. Now, instead of blindly following moving averages, we use candlesticks to confirm whether price respects the moving averages. Okay, we use candlesticks to confirm whether price respects moving average or is about to reverse. So some key candlestick patterns to watch include pin bars. All right, pin bars or rejection wicks. Okay, so you can see something like this. Pin bars or rejection wicks, they indicate price rejection at key levels. Most of the times you're going to find pin bars around support or resistance levels. Another important candlestick pattern to pay attention to is the engulfing pattern. Engulfing candle shows a strong reversal when one candle fully engulfs the previous one. You can see what happened here. And another important candlestick pattern to watch out for is the doji. The doji, right? You can see it signals indecision. Okay, usually has a small body and then wicks above and below, right? It signals indecision often before a big move. And then the morning and evening stars are under important candlestick patterns. They come in threes, right? You have a bullish pattern, a bullish candlestick, a doji, and a bearish candlestick representing an evening star, right? That's for an evening star. Then you have so perhaps something like this, Then for the morning star is going to be a bearish candlestick pattern, and then perhaps you're going to see a doji, and then a bullish candlestick pattern. So these three, three candle patterns, they are also very important patterns to watch out for. Okay, let's see if we can just find any. But sometimes you might not easily find those patterns. It's not always that they appear. So that's the reason why I just decided to use a diagram to represent it. Okay, but if you see the pattern, you are going to you're going to identify it. You just have to be looking out for a bullish candlestick, a doji, and a bearish candlestick consecutively for the evening star, and then a bearish candlestick, doji, and a bullish candlestick consecutively for the morning star. Okay, so by combining all these patterns, with moving averages, we filter out bad trades and focus on high probability setups. Okay, now that we understand both tools, let's break down how to combine moving averages with candlestick patterns to enter strong trades. The first step is to identify the trend using moving averages. Okay, if price is above the moving average, we focus on buy trades. If price is below the moving average, we focus on sell trades. Now, the 50 EMA, remember the 50 is the red, the 200 is the black, right? The 50 EMA and 200 EMA help determine the overall trend. Okay, so the next step is to wait for price to touch the moving average. Okay, so if price pulls back to a moving average, it acts as dynamic support or resistance. We don't enter yet, we wait for candlestick confirmation. Okay, so if price touches the moving average and let's say it forms a bearish engulfing like what happened here, okay, it shows a strong sell signal. On the other hand, if it forms a bullish engulfing like what happened here, it shows a strong buy signal. Maybe it forms any other bullish candlestick pattern, it shows a strong signal in direction of that candlestick pattern. Now the next step is to enter the trade. For a buy setup, if price is above the moving average and you notice a bullish candlestick appear, a bullish candlestick pattern, then you can enter when the next candle confirms the move. For a sell setup, if price is below the moving average and you notice a bearish candlestick pattern forms, you can enter when the next candle confirms the rejection. Okay, so this combination ensures we don't take random trades based on just moving averages. It helps us to trade smarter. All right, now not every moving average touch is a good trade opportunity. Okay, so here's how to avoid fake setups. Always check multiple time frames. It is important. Confirm your trends on the higher time frames before trading on lower time frame. You can execute your trades on lower time frames, but confirm your overall trend on the higher time frame. Okay, then look for confluence. The best trades happen when the moving average aligns with support and resistance zones. Okay, that's when the best trades happen, when the moving averages align with support and resistance zones. Okay, and then avoid choppy markets. Moving averages work best in trending markets, not sideways price action. So by following these steps, you filter out low quality trades and only enter high probability setups. And that is how you combine moving average with candlestick patterns to improve your trade accuracy. If you found this strategy helpful, hit that like button and drop a comment below. Let me know which candlestick pattern you use the most. Subscribe to the channel and turn on the notification bell so you never miss new trading strategies. In the meantime, thank you for watching and I hope to see you in the next video. Happy trading.